Hey guys, Mike here. So, oh boy, another red day in the market. I don't think anybody's surprised at this point in time because there's just a lot of pressure right now pushing down. I mean, this would be the fourth week if we end up red this week that we sold off and stuff. So, again, we're gonna go over the chart. I'm gonna show you exactly the magnet that you see and how powerful some of these levels are. And some people wonder. I'm gonna show you exactly why it's a big deal on a global level that we're actually tightening, and not only tightening, I'm talking about the Fed and the central banks around the world, but tightening into a slowing economy, which is a very rare event in the history of our country, or most countries for that matter, because it's not a very smart thing to do, but they have to because of inflation, right? So that's why it's very rare you see this. And, just looking at what I was talking about real quick, we're going to go through a bunch of stuff, but looking at the S&P, right here, I showed you this 618 level and the Fibonacci retracement level, and you can see we just kind of zoom in on the hourly. I mean, it's bounced. You saw a nice little bounce, and it's just like a magnet. It didn't want to go below it, but then the bulls pushes back above it, the bears pushes back below it, and so it's just this huge fight along that level. Because if we lose that level, obviously we're heading down farther. Another thing to look at when you're talking about tech, risk, and all that, remember I showed you this, it's the QQQ divided by the SPY, whether we're risk on or risk off. Right now you can see we've been heading down, so we are definitely risk off. You see crypto selling off, but we're approaching that trend line once again that we bounced back in May and June on, which kind of started that rally. And you can see going back many years, it has bounced off this many times. So we're approaching it now, and we'll see if we hang on to that. The other thing to look at here is the 2-year Treasury yield versus the S&P. And last time it was this high, you can see that's when we hit the June low, right? We were much lower than we are now, probably about 8% lower on the S&P. And we're right there again at the 2-year Treasury yield, and that's where we're at on the SPY. So, much higher, as you can see. So it's a big question whether or not we're going to hold or continue to head south. And by the way, if you get anything out of this, please hit that like and subscribe button for me. I really appreciate it. And, the big thing that confuses people, and in this environment it should confuse people, which is when interest rates go up and the Fed has raised rates in the past, the stock market's going up with it. No big deal, really. You'll have a taper tantrum or whatever sometimes, but for the most part, the market can handle it. But of course, what do you see happening now? They're raising rates into a slowing economy, not a strong economy. And so, I mean, the reason why is because inflation, right? Inflation is taking money out of the system on its own, on top of the tightening. But it's not only in our country; it's on this massive global scale that I don't think we've ever seen it before. Obviously, I'm not 80 or 90 years old, so if you are and you were around the 50s, 60s, 70s, and 80s, I don't know. Have you've seen on a global scale this much tightening going on? Because obviously we have not. And China is starting to, I told the members this morning, they're actually ramping up stimulus, right? Because, I mean, who knows what's going on? I mean, I don't believe anything coming out of China as far as the numbers, the economics, and all this stuff like that. Their inflation is 2.75%. Who knows? Maybe it's true. I don't know. But imagine if they were actually really tightening and worried about that kind of stuff, and their numbers were actually real coming out of there. It would be even worse instead of the second biggest economy. But supposedly they're doing stimulus, which is not a good thing. It just means their economy is tanking because nobody wants to buy their houses anymore because of that huge, obviously, Ponzi or pyramid scheme they had going on over there. The bubble they've been propping up, I think it's the biggest bubble in the world or something, but at least one of the top 3 for sure. But the reason why is because here's what's going on, guys. You got global debt outstanding roughly around 300 trillion. Average maturity rates around 6 to 7 years. Average yield increases since 2021's 300 BPS. So if yields stay here in nominal terms, that means borrowers have to pay about $1.5 trillion more per year to refinance the debt. And I'm pretty sure this right here is the reaction of people who hold this debt, or I know, well, when I saw that, I mean, I already knew it, but if you've never seen it before, you're like, oh my God. And so that is a big deal. I mean, we're talking about a T, so trillions of dollars. And we got plenty of companies right here, publicly traded, they will have to take on debt to make it through, the next couple of years or whatever, if we do continue to slow and have a slowing economy. And, every dollar matters, right? Because, I mean, especially when it comes to the stock market, because a lot of companies, what they were doing, especially when rates were zero, they're just taking out the money, right? When it cost them hardly anything, and then just buying back their stock to help drive up the stock price as well as expand their business by growing it. And so that's why you see like Amazon, the news came out then, they shut down one facility, they postponed, they were going to have 42 more fulfillment centers, I think it is. And so they've already pushed that off. Who knows till when, but it'll probably be a while for sure. I mean, I think they'll wait till we get through all this mess to try to do that. And so, that's the big deal about raising interest rates. The roll off of the balance sheet will totally affect the market in a totally different way. But, you see I think I read the other day, or actually today, that, buying a house, if you're buying a house, let us know in the comments, like, what's your mortgage rate you're actually getting in on? 'Cause I saw where a fixed 30-year mortgage rate's over 6 now. I saw 6.15, I saw 6.3. I mean, that's pretty dang high, right? Imagine. And the prices are higher. Now, the prices are definitely starting to come down for sure. And in some areas, they're cratering. In my area, it's cooled off a whole bunch, and the prices are starting to come down even more now because I track my own house and other people's in the neighborhood. So, and we're in a very hot market. And so that's a good thing for people who want to buy homes. People keep calling for an '08 crash. I cannot possibly see it unless the banks start doing what I talked about to you, I think it was Sunday or something, when I talked about what Bank of America was doing with, basically no minimum credit score, no down payment. I mean, if they start to roll out those kind of policies and lending practices, then that could definitely, in a long run, hurt the real estate market and have like an '08 type feel to it. But besides that, I'm not really sweating that myself. And, the other thing to look at is Morgan Stanley. They've been pretty good about this, projecting earnings per share forecasts and stuff. And so you see the dotted lines, their forecast, the solid line is actual. And this goes back to 2001. And, they're off, even 5 to 10%. But for the most part, they're, somewhat in the ballpark, right? I mean, you can see you follow it through the years. Again, can be off 10%, can obviously think it's going to drop even further, and it does not. And you can see right there going through 2016, 2020. But you see right now, they've been somewhat on point over the top part, but you see what they're projecting it to be. And so for me, I look at that and I say, okay, well, if it's either going to be 5 to 10% above that or 5 to 10% below it, but even if you do that and take that in consideration, guess what? Since they've been pretty accurate with this somewhat, again, if you take the 5 to 10% up or down on that, you're looking at a nice big drop on earnings per share over the next few quarters here. I'm looking at that. That's through 2023. And so, again, they've been okay at it. We'll see, right? Again, I'm even saying, okay, well, if it's 5 to 10%, it doesn't drop as much. It still has quite a ways to drop, all right? And then if they're too conservative on it, it can drop even farther, which let's hope that's not the case, because that means we'll be dropping a lot farther. Then, but I thought that was interesting because they have been pretty good at that. And, the big thing is, I think Jerome Powell speaking Thursday, like 9 o'clock at night. We'll see what happens there, what he has to say. You never know with this man, what he's going to say. He might turn out to be dovish, or the market goes, oh my God, he's dovish, But let's be real. It's all about next week, right? It's all about inflation. That's what this is seriously all about, right? And I don't think it's even that much about the interest rate hike. It depends on what inflation is. And inflation still shows that it is either flat or rolling over. That's a very good sign. I know certain areas for sure, like the grocery bill, groceries are definitely coming down in my area. I don't know, I assume they're coming down everywhere. Gas is coming down in my area. Cars are not. And again, I'm curious to know if the $10,000 extra they're charging over sticker prices actually count towards the price and inflation, or are they not counting that part of it? And so I'm curious about that. But, housing is coming down. Rents are probably not, that's for sure. What to see on that one. But there are, little cracks here and there, and this is what you look for in the labor market, right? This is what the Fed watches like a hawk. And I saw this come out today, and this is people who have less than a high school diploma, so most likely people flipping burgers, that kind of stuff. And you can see it's actually gone up from 4.3 to 6.2. And so that's a 2% jump. Nobody's really talking about this, but a lot of people, believe it or not, make up this field here. But when you look at it, though, it's really just where the norm was going through like 2009. We got super low. I'll tell you, look at that. You ever see that low? No, not going back to 1992. And so we just got really, really low, and now it's really back to normal, I think. I think 6.2 might be normal for these folks. Because if you have less than a high school diploma, I don't know how many jobs are out there, that need that film, but it's tough, And so, but you're seeing that part, go up. And so, again, I don't know, to work at Amazon and fill packages, do you need a high school diploma? I have no idea. Seems like to flip burgers now, they want a high school diploma. Honestly, I'm not sure about that. But you're starting to see those little cracks in the labor market, and that's what people are going to watch very carefully. The unemployment rate, 3.7, which is still historically very, very low. Okay, and the one thing I don't really believe it, but maybe it's just true that you keep saying we still have I keep throwing around this $2 trillion number that we have in the banks supposedly, and I'm thinking you've been saying that since the beginning of the year. At some point in time, hadn't inflation ate into that $2 trillion? I mean, seriously, if you got every stimulus check, what was it, 1,200 a couple or something? And they send out 3 or 4. So let's say you got $8,000, right, as a couple. I mean, through inflation, hadn't you paid more than $8,000 just in from January to June in gas and groceries and utility bills and anything else you went out and bought? And if you traveled, you dang sure paid more. Hadn't you already spent that $8,000? Isn't that gone by now? I'm just curious. It's just me. They keep throwing that around. We still have this extra. I'm like, I believe certain people do, but most people do not. I just don't see how they can possibly still have that money unless they became successful day traders or swing traders or whatever. But, just curious your thoughts on that one, because they keep the same number all over and over, like it never goes down or something. So I don't know. Again, I have a problem even finding that data anymore. Somebody sent it to me and I showed it to you guys, but having updated data, it's a problem. And so I don't know. We'll see on that one. But, the economy tends to pump. I think the market, like I said, is going to stay in. I believe it really truly is going to stay in this range, right, until we hit that CPI number next week. And again, it's just a great time to sit there and accumulate cash, buy at discounted rates, and do your research. That's really what you're looking right here. That's what I do. That's why I don't sit here every day going, oh my God, it's red or green. Woohoo. I mean, come on. And if things turn really green, you just go ahead and go, why is everything turning really green? Like, what's going on here? Right? Because again, the Fed will pivot, and understand the market will turn before the pivot. And because people will tell you in August 18, it was December 24th was the bottom of that drop. But I looked, and the news announcement was on February 22nd, 2019, of when they announced they would do no more rate hikes, right? And so basically 2 months after that, but the turn was Christmas Eve, right? And the Fed ain't gonna be talking on Christmas Eve anyway, saying we're done rate hikes. That makes no sense. But it's that was when we ended. Yeah, we did, but they didn't officially announce it, so I don't know how the whole market knew it, unless it was a guess like you saw in June, right? And so that's what you're going to see when the market actually will turn. Is it's going to be a guess. Who knows if they're right? They weren't right in June, right? And then you'll see an announcement 2 or 3 months later, probably saying, oh, okay, we're not going to do any more rate hikes, but we're going to hold. But again, look what I showed you. How much more it's going to take to service all the worldwide debt with these higher interest rates, right? It's no different if you were trying to refinance right now. Look at the rate you'd have to take out now versus what we did in 2020, right? It doesn't sound like a lot, but when you're dealing in hundreds of billions and trillions of dollars in debt, it's a lot. Okay, I can't imagine, looking at those books and all those zeros, right? So anyway, hope you guys got something out of it. Hit the like, subscribe if you did, and I'll see you guys tomorrow.